So in this video we're going to talk about options and volatility. And so I think a lot of people, especially when they get started into options, they'll buy an option at random, they'll buy it blindly without looking at volatility or really understanding volatility. And they'll see that maybe the stock just goes flat or even goes in the direction that they expect it to go. And yet they'll be shocked to see that their option has just completely collapsed in value. And the reason why is because the volatility that you purchased, right, the implied volatility or the volatility that the option was priced at was much higher than the actual volatility of the stock. So hopefully at the end of this video you'll have an understanding of what a cheap option is compared to an expensive option. And that's all based on volatility. So the two big things, I think, when you look at volatility is the implied and historical volatility. And implied volatility, this is, what every broker has on their options. You'll probably see this number quite a bit. And what this is it's a percentage. And that percentage is what the stock price is expected to change by within a year, right? So if it's priced at 45%, as this table shows, as the implied volatility, which is from the option price, then it's expected, the option is predicting that the price of the stock, underlying stock, will go up or down 45% in 365 days from now. If the stock price, for example, goes up 50%, you're in a profit if you buy options. If it goes below 45% in a year, then you're not so good. You might lose some money, which is good for the sellers, but not for the buyers. And the historical volatility is derived from the actual stock price, right? Compared to implied volatility, which is derived from the option price. And historical volatility, you can look at, it's usually a moving average. So, like, for example, if you just did a one-day average, probably it wouldn't be called an average, but, say one-day volatility is 5%, then historical volatility will be 5% times how many ever trading days there are in 365 days, right? So like 200 something times that 5%. And that's the historical volatility. And by comparing these two numbers, we can tell if the implied volatility is high or low. Or at least that's what I do. And for example, right now, which is very unusual, the historical volatility is much higher than the implied volatility, which is 37% right now. So right now you could say that options are very cheap. Typically what you'll find, this is a very unusual time right now where with the whole coronavirus thing, it's slightly recovering. Throughout this whole coronavirus thing, 90% of the time, or, until now, options were very expensive, right? Historical volatility was much higher than, or much lower than implied volatility. But it's all changed right now. So, while I was selling options before, now I'm kind of going more buying, right? I'm not using this solely. I'm also using some technical analysis, but I'm not going to buy options when they're expensive, right? Even with the most perfect technical chart out ever, I will not buy an option if they're expensive or over the historical volatility for 2 or 3 days. So a website like this is very easily found online. You just search historical versus implied volatility, and you'll find a couple of websites like these. And these are very, very fantastic. So the VIX, this is widely used to determine, well, it just shows volatility in the S&P, but a lot of people use it to determine if they are avoiding buying options or selling options. Or this is somewhat stupid because this is just like looking solely on the implied volatility, right? And ignoring the historical volatility. There's no like comparison in just looking at the VIX. You can look at it if it's on the extreme sides, like if it's 80%. The chance of it. All right, let me explain first what the VIX is before I get ahead of myself. The VIX is based on a standard deviation, right? One standard deviation, so that's 68% chance of something happening. And the stock price is a percentage. So what this is saying, if the price is at 41.67, that means there's a 41.67% chance that the stock. I messed that up. There's a 68% chance that the stock price will go up or down 41.67% in a year, right? So there's a 68% chance that the price will go up or down, the stock price of the VIX. So I don't use it, but it is so widely used on like from analysts and on TV every day. I kind of have to put it in because otherwise, it wouldn't. It's always good to understand what this is, but it's very useless. I think I never use it. I kind of just look at it sometimes, but it's such a stupid instrument in my opinion. It's just such a useless thing. You can just look at implied volatility and that's enough. And I mean, and historical volatility. I mean, this is like looking at implied, and it's just such a stupid thing. And some people say this is for predictive like reasons, like what it's supposed to predict what's in a month the volatility is, but people have shown that this is completely stupid, that it has no like predictive abilities, but people still use it, so I don't know. If I just suggest maybe you can look at it sometime, see what the general market is doing. This is great for like if you're an investor or something, you can look at what the market is doing, like volatility wise. But if you're trading options, this is just there's nothing to compare it to, so it is useless. So yeah, just don't use it. Okay, so you might be wondering what the historical volatility versus the implied volatility was, or realized volatility. And as you can see, there's 1 year where the VIX has been lower than the realized volatility. So what that means is that sellers of options have done tremendously better than the buyers. There's a massive edge for selling options, right? And the simple reason is because there's fewer sellers than there are buyers, right? Everybody wants to use leverage, but very few people want to put the collateral for the leverage. So it's very similar to like if you have an orange farm or you're a drinker of orange juice. If there's a lot of sellers of orange juice, you want to be a consumer, right? You get low prices, very good for the consumer. If there's very few farms, right? If there's very few farms for oranges, then you want to be a farmer because there's a lot more profit to be in there. So this is a big case for sellers. You have to beat not just you don't just have to beat half the people in the market. You have to beat like a lot more than that. It's similar to horse racing, right? Like the bookie takes 20% or however much away from the game. So you don't just have to, be even. You have to be better than even to break even. So it's very difficult for buyers. But if you use the historical versus the implied, you can kind of get around this when you buy options. But you have to be very patient. You have to wait for opportunities where there's historical volatility is at least equal to implied, or best case is historical is greater than implied. right? And if you're a speculator, at least have them close. Sometimes they're so extreme that I don't understand why people buy options on them. There's such a huge gap. Yeah. So, and there's another chart showing the edge, 8% in 2009. Casinos have like 1 to 2% or something like that. So there's a pretty big edge for sellers. But the problem with selling options is, of course, you have to have collateral. So your return of investment is going to be relatively low compared to what a buyer has a chance to make.